Welcome to SS2 Economics, Term 1, Week 3. Today we study investment and the marginal efficiency of capital, a key concept in understanding why investment fluctuates and how interest rates affect economic activity. In economics, investment means spending on capital goods, machines, factories, buildings, and infrastructure that are used to produce other goods and services. Investment is one of the most volatile components of aggregate demand and a major driver of economic growth. In Nigeria, both private investment, from domestic firms, and foreign direct investment, and public investment, from government infrastructure spending, are crucial for economic development. There are several important distinctions in investment. Gross investment is the total spending on capital goods in a period, including replacement of worn-out capital. Net investment equals gross investment minus depreciation, capital consumption. Net investment represents the actual addition to the capital stock. If gross investment equals depreciation, the capital stock is merely maintained and net investment is zero. Planned, ex ante, investment is the investment that firms intend to make. Actual, ex post, investment is the investment that actually occurs, which includes unintended inventory changes. Autonomous investment is investment that does not depend on the level of national income, for example, government infrastructure spending or investment driven by technological innovation. Induced investment is investment that rises as national income rises. As the economy expands, firms invest more to increase productive capacity. Residential investment is investment in houses and buildings. Business fixed investment is investment in machinery, equipment, and commercial structures. Inventory investment is the change in stocks of raw materials, work in progress, and finished goods. The marginal efficiency of capital, MEC, is the expected rate of return on an additional unit of capital. It is the rate of return that makes the present value of the expected future income stream from an investment equal to the cost of the investment. Keynes introduced this concept to explain investment decisions. A firm will invest in a new machine if the MEC exceeds the market rate of interest. If a machine costs 1 million naira and is expected to generate 150,000 naira per year in additional profit indefinitely, the MEC is 150,000 divided by 1 million equals 15% per year. If the interest rate is 10%, the firm should invest. The return of 15% exceeds the cost of borrowing at 10%. If the interest rate rises to 20%, the firm should not invest, because the cost of capital exceeds the expected return. The relationship between the interest rate and investment: as interest rates rise, fewer investment projects are profitable, so investment falls. As interest rates fall, more investment projects become worthwhile, so investment rises. This inverse relationship between investment and the interest rate is represented by the marginal efficiency of investment (MEI) schedule, a downward-sloping curve showing the level of investment at each interest rate. Many factors influence investment beyond the interest rate. First, expected profitability. If firms expect the economy to grow and demand to rise, they invest more now to increase future capacity. Business confidence is crucial. Second, the existing capital stock. If firms already have excess capacity and used machines, they will not invest in new capacity even if profits are high. This explains why investment is low at the start of a recession, even before interest rates rise. Third, the cost of capital goods. If machine prices fall due to technological progress, more projects become profitable. Fourth, technological change. New technologies create investment opportunities that did not previously exist, such as mobile telecommunications infrastructure in Nigeria in the 2000s, which attracted massive investment. Fifth, government policy. Tax incentives for investment, such as capital allowances and pioneer status in Nigeria, stable macroeconomic conditions, and public investment in infrastructure, roads, power, ports, all encourage private investment. Sixth, access to credit. In Nigeria, high bank lending rates, often 20 to 30% in nominal terms, have historically constrained private investment. The CBN's interventions, such as the development finance institutions and sector-specific credit programs, aim to lower borrowing costs for key sectors. Investment is central to Nigeria's economic development challenges. Nigeria requires substantial investment in electricity generation. The country has approximately 13,000 megawatts of installed capacity but only generates 4,000 to 5,000 megawatts reliably, in roads and rail infrastructure, in water supply, in manufacturing, and in human capital, education and health. The Investment and Securities Act governs securities markets. The Nigerian Investment Promotion Commission, NIPC, facilitates foreign direct investment. Foreign direct investment, FDI, brings not just capital but also technology, management skills, and market access. Nigeria receives significant FDI in oil and gas, Shell, Total Energies, ExxonMobil, Chevron, telecommunications, MTN, Airtel, and banking. Domestic private investment is driven by access to finance, infrastructure quality, security, and regulatory environment. The World Bank Doing Business Index has historically ranked Nigeria poorly on ease of doing business, though improvements have been made, which depresses domestic and foreign investment. Addressing power, infrastructure, security, and governance challenges is essential to attract the investment Nigeria needs for sustained growth and job creation. To summarize, investment is spending on capital goods. Gross investment minus depreciation equals net investment. The marginal efficiency of capital, MEC, is the expected rate of return on an investment. Investment occurs when MEC exceeds the interest rate. Investment is foregone when MEC is below the interest rate. The MEI schedule shows an inverse relationship between investment and interest rates. Factors affecting investment beyond interest rates include business expectations, existing capacity, capital goods prices, technology, government policy, and credit availability. In Nigeria, high lending rates, infrastructure deficits, and policy uncertainty have historically constrained investment. For WAEC, define MEC, explain the inverse relationship between investment and interest rates, list factors affecting investment, and explain the role of investment in economic growth and development.